Thank you, Mike. Now please welcome the Key Statistics panel.
Good morning. You feel better now than you did this morning at 9 o'clock? Or you feel worse? That was, wow. I mean, I think we're all looking at the same data, but that was glass half full all the way. Let me give you the other perspective. Thank you so much for having us back. My name is Jan. I'm with CoStar. We each have 10 minutes, and then Lee's going to come out and do questions. If you want to ask us a question, do not raise your hand. Go through the app, and then Lee is going to get it on his iPad. So what I want to tell you about is the state of the industry, but unfortunately right now I have to say the uncertain state of the industry because I don't know. Like, we're supposed to know, and we're putting a line in the sand here with forecasts, but I mean, you just heard a very positive perspective. We're going to be fine, and I hope he's right. But, so, we use a different macroeconomics forecasting engine called Oxford Economics, and they're saying uncertainty is suffocating the economy. This is from a week ago. They said they revised their GDP growth down from 2.4 to 2%, and the odds of recession have risen in their perspective to 30%. Last week I was in Phoenix at an AHLA event listening to Larry Summers, former Secretary of the Treasury, and his odd for recession is 50%. So it's bumpity bump out there in the night, people, and I hope, you know, our prior speaker is right, but this is not the way we look at the world. We, of course, have to make a forecast. We have not changed our forecast. This is what Amanda Hyde from STR presented at the Alice Hotel Investment Conference. Last year, RevPAR grew by 1.8%. This year, we're expecting RevPAR to grow by 1.8%. At NYU, we will have a new forecast. We were just not quite ready yet to change where we are because we don't have quite enough data yet. But what are the main takeaways from this slide is, number one, supply and demand are in balance, so occupancy change is still de minimis. Number two, the ADR% change is below the level of inflation. Pick your number, 2.3, 2.5, 2% or so. We're not getting there, right? Pricing power is below the level of inflation, which puts pressure on margins. The other thing is we're putting our neck way out and having a forecast for 26, for 27. Take that with a truckload of salt. That will be revised. But Jan, the first quarter data so far looks really good. Like, how come you're not more positive? Well, let's talk about that. So this is demand percent change, not RevPAR, demand percent change for the last 3 months, right? And December was pretty strong. And January was pretty strong. And February prelim, that came out this morning, was pretty good. But you take the first 2 months of this year, January and February, together, the year-to-date demand percentage is 1.4%. And one of the best analysts out there, Isaac Collazo from STR, made this chart, so I stole it. I like his story here. What he's saying is this: 1.4% with an asterisk, and you take out the markets impacted by the hurricane, and you take out the markets impacted by the LA wildfires, and you take out the top 25 markets, and you end up with, for the 133 markets that we track, 0.2% of demand change. And unfortunately, that I think is going to be the tenor for the remainder of the year, that we are going to see a top line that looks pretty good, but then you have to unlayer it and say, oh, underlying that is maybe not as strong of a hotel industry as we'd like it to be. And keep in mind that this is before all the rhetoric from the administration. This is before all the tariffs. This is before people who have money in the stock market feel less wealthy. So we are not super duper optimistic like the gentleman from Truist was. What's happening on the demand side, though, continues to be this bifurcation story that we talked about all through 2024, and that's actually also our forecast for 2025, that the upper end of the market will do quite a lot better than the lower end. Again, I'm looking at just at demand percent change for the first 2 months of this year, and you see that for the luxury end, the luxury traveler is still saying, yep, I own my own house, and it's worth a lot more than in 19. I'm in the stock market, and that's doing quite well, thank you very much. And I booked this trip probably in December or in November for January and February, and yes, life is pretty good. But on the lower end, where the American consumer, yes, maybe talking about egg prices as we heard this morning, that's where people are on a budget, all the forces of higher inflation eating into the travel budget. So room demand on the lower end is, flat for all intents and purposes. And that's, I don't think, good news looking ahead. And that is all before the rhetoric from the administration kicks in. So this is the latest data. This is not CoStar data. This comes from the Department of Commerce. It's the I-92 APIS data set, which is free, and it's awesome, and you should use it. It shows you how many people fly from the US elsewhere and how many people fly internationally into the United States. And what you're seeing here, this is just Canadians coming to the US, flying into the US, not land crossings, flying into the US. And what you're seeing is that the number of Canadians has grown flying into the US since the pandemic, high single digits, low double digits, except in February, right? It declined for the first time. And to me, this is not a blip. To me, this is a trend, right? We're going to continue to see that. If you're exposed to the Canadian market up on the northern borders, or if you're in Scottsdale in Florida, pay close attention to that. Also, if you're exposed to the international inbound, you've already lived this. There's a lot going on here. This is just a screenshot from that website from the Department of Commerce. The point here, the two most important numbers on here are -8 and +21. Number of international travelers coming into the US in 2024 is 8% below where it was in 2019. Number of Americans going abroad is up 21%. Compared to 2019. Why? Because the dollar is so strong, right? And in 23, everybody went to Venice. In 24, everybody went to Tokyo. In 25, who knows where we're going. But if the dollar is that strong, we may still go abroad. But the rhetoric from the administration is such that I think that number of international inbound will decelerate. We heard yesterday in the Wall Street panel, Shai was talking about, 26 World Cup. I'm like, yeah, man, I'm German. I'm all for the World Cup. But there was one German woman detained last week by ICE at the border, and that is all over the German news. And Germans love to travel and they love their soccer, but if they don't feel welcome, they're just not going to come. So I'm super worried about the rhetoric that has an impact on international inbound, as we have seen already. This is just the strong dollar, but you add to that other forces, and I'm worried about what happens with international inbound. Of course, when we talk about rhetoric, we have to talk about labor, right? This is again from our friends from Tourism Economics, and you all know that in the accommodation sector, 15% of workers are non-US born, but in the back of house, 1/3 of housekeepers are non-US born. We need immigrants to help us do the services that we provide as we keep charging higher rates, but if we don't have people, or if other industries see an exodus of workers in the construction industry, in the cleaning services industry, they will increase their wages, which means we will have to increase our wages. So I just told you about ADR change, which is not nothing, but it's not something. It's sort of below the level of inflation. And then you get pressure in the middle of the P&L from higher wages, likely higher insurance, and then if you're an owner, from higher property taxes. That doesn't make for a super optimistic outlook for 2025 and beyond. So I'm very, very curious to see how we are going to continue to attract the talent that we need in order to provide the services. Let me finish with 3 quick slides on real estate. Number 1, pipeline. The number of rooms in construction has been between 150 and 160,000 rooms for over 3 years. What does that mean? It means that, yeah, some hotels open, and yeah, some hotels are breaking ground, but overall, there's not a whole lot going on. So the supply percent change last year was 0.5%. The long-run average is 1.7. So new supply is really not a big headwind outside of New York, Nashville, Phoenix, Dallas, but overall, it's really not that big of a deal. But then you're looking at the other data sets and you're like, but Jan, these are the highest numbers that we've ever seen in planning and final planning. True, but I think some of this is vaporware, right? I mean, you're here all trying to make this stuff happen and you have beautiful plans. I see the renderings, they're beautiful. But can you finance it, right? You're going to the bankers and they're like, yeah, we don't do construction loans anymore. Or, yeah, you can do it, but it's SOFR plus 600, whatever. You know, and you're like, let me just sit down. So I think this is going to impact the industry eventually, right? Over the next 2 to 3 years or so. I'm not super worried about new supply outside of a few markets. Number two, higher interest rates, of course, have an impact on deal activity. That's why you're here, right? To make the deal, to figure out what is the bid-ask spread, and hopefully there is no spread, and you can get the deal done. But what we've seen with the higher interest rate environment is that 2024 total deal volume was below 2023, which was below 2022. And for the first quarter of this year, which is on the far right-hand side, and this is through March 15, so we still have 2 weeks to go, but in the first quarter, total volume was roughly $2.5 billion or so. Last year, first quarter was $4 billion. So, you know, I wish all of us that the brokers are right, and Lee will have an opinion. I know our friends from JLL and the other CBRE brokers are very, very bullish for this year, as they should be, and I hope they're right. I just don't see it in the data yet, you know? And when I talk to some of you about deals, you're like, yeah, there's just still this delta between bid and ask. So it's going to be super interesting to see when we get back together at NYU to see how that bid-ask spread was gapped. And then lastly, this is an indicator of delinquencies. The point here is just to say there aren't a lot of delinquencies, which is not driving a lot of transaction activity. So this is CMBS, commercial mortgage-backed security, delinquency rates, and you can see the number hasn't really moved, right? It's between, call it, 5 and 6% or so. Why? Because the debt markets are wide open. And you know this if you talk to your favorite lender. They're like, yeah, we can probably not extend and pretend we have to refinance and at a higher rate, but at least there's money available for existing properties with a good story. And so we don't expect delinquencies to peak. We don't expect delinquencies to pick back up. We don't expect delinquencies to do anything. And if you look at this chart, it's a little bit hard to read, but I'm showing here 30 days, 60 days, 90-plus days delinquent. 90-plus days is the dark blue line. The point here is the dark blue is a huge percentage of this. There are not a lot of new delinquencies coming into this data set. So what is delinquent, but everything else is sort of working itself out and doing quite well. So not a wave of distress, which means that is not going to push transactions. I think you will be here at Hunter and the other conferences throughout the year, and you will try to make these deals happen, but don't bank on a lot of distress. If you found this interesting or you want more of it, please join us once a month. We have the Not a Lot of Hair, but a Lot of Good Data podcast. The Tell Me More Hospitality podcast comes out. Isaac and myself riff about the data once a month. Please join us there. With that said, thank you very much for your time. Have a great Hunter conference, and hand it over to Mark.
Good job as always, John. I agree a lot with what Jan said. The uncertainty is certainly there, but one thing about uncertainty is uncertainty equals restraint. When people are uncertain, they start thinking about, do I need to travel? Do the companies need to travel and all that kind of stuff? So I'm going to take you on a little bit of a demand story for 2025. And I'm going to start it off by saying that long term, meaning beyond 2025, extremely optimistic about how the industry is going to do from all kinds of perspectives, from deal making to transactions to performance. But 2025 is going to be challenging. And it's going to be challenging from a demand perspective from all kinds of reasons. This chart shows a 3-month moving average of occupancy from 2025 to 2024, 23 compared to 19. And you can see that demand levels haven't gotten back to 2019 levels. So that's demand point 1, okay? So demand still hasn't gotten back there, and some of the things that are going to happen in 2025 are going to make it hard for that to happen now. So if you look at the composition of demand and you oversimplify it, okay, and say there's basically 3 kinds of travelers. There's leisure travelers, there's commercial travelers, which you could call business travelers, and there's group. And this is their composition, the blue line being leisure, red line being commercial, and group being the aqua line at the bottom. and how they comprise the total. So over the last 18 months or so, about 55% of all demand is leisure. And that's really propped up the industry over the past couple of years. And that's good for a number of reasons. One is they stay longer. Two is they're less price sensitive than corporate travelers and group travelers, okay? But the other thing about that is because they stay a little bit longer, if that transient leisure demand slows down a little bit, in order to replace that, you can replace it with either corporate or group. But they don't stay as long, so it's not a one-to-one relationship. You don't replace one leisure traveler with one commercial traveler. It's about 1.1, 1.2 to 1 if you're gonna have that kind of, if you wanna do that little bit of math. And our view is that the leisure traveler is going to be probably flat. There's not gonna be a lot of growth in leisure travel in 2025. So that means in order for occupancy to improve or even stay the same, there has to be the commensurate either similar in corporate and group or a little bit more. And my guess is, my gut tells me that that's not gonna happen, okay? Now, what I wanna do is take you through a little thing of how consumers actually book rooms, which is a good indicator of kind of what kinds of travelers are coming. So these are the major categories where people book, rate categories that they can use, okay? And almost 85% is in 5 categories. But the 2 I'm gonna concentrate on are corporate, which is about 13%, and government, which is about 4%. Now, people who travel for the government usually book those rooms or use a government rate, but not always. Corporate people don't always use the corporate rates. They might, use their loyalty member rate. All kinds of noise in here. But nonetheless, it's a good indicator, okay? This is room night demand by booking rate category. And the 2 I want to concentrate on is the one at the top, which is promotion and loyalty rates. And you can see that the brands over the past couple of years have done a very good job of creating an increase in their loyalty members. So if you're a loyalty member, you go on Marriott.com, Hilton.com, Hyatt.com, you're gonna probably book a loyalty member rate, which is why that number's so high. And then I'm gonna concentrate for a second on the corporate one, which is kind of the light blue line at the bottom. And you can see that corporate bookings remain about 10% below where they were pre-pandemic, okay? And there's no reason to expect that that's gonna change in 2025. Now look at the government rate, which is in that kind of yellow line. Again, relatively flat, consistent with 2019 levels until you get to January and February. Okay, so already you start to see a little bit of lagging in that government rate, okay? And we think that that's gonna continue, and I'm gonna talk a little bit more about that. The other interesting thing, which is a huge change from any other cycle, is the industry's ability to price their rates higher than they did before. Every other recovery, demand has led ADR. In this recovery, ADR has led demand. And the same thing happens here. What's interesting is that the much tighter window, okay? In terms of the difference between, demand and ADR. So the ADR remains strong because it has to. Jan mentioned, cost. Robert's gonna talk about costs. You can't be in a situation where your expenses are growing faster than your revenue. It just doesn't work. It's not healthy, it's not strong, it's never gonna be successful. So that's why the ADRs are so strong. And this is the RevPAR, which is just the math, okay? Now I'm gonna talk about something that's considerably different than pre-pandemic levels, and that is the average length of stay. If you concentrate to the right-hand side of the chart, you'll see that the length of stay for an average guest when they check into a hotel room in 2019 was 1.9 nights. It's now over 2 nights, okay? Which is surprisingly healthy thing for the industry. But think about what I said before, okay? That demand has not gotten back to 2019 levels. So if demand hasn't gotten back to 2019 levels and people are staying longer, that tells you there's a lot fewer check-ins. Has to be. That's the only way the math works. There's a lot fewer people traveling, okay? Now this next chart will indicate where that's happening. This is the percentage of check-ins that stay 1 night, 2 nights, 3 nights, all the way up to 6 nights, and then kind of extended stay categories. And you can see that almost 2/3 of all the check-ins in the US are for 1 night stay. But in 2019, that was 64.3%. In 2024, it was 62%, 62.8. That doesn't seem like a lot, okay? But it's huge. If you say, just oversimplifying, if there's about 3.2 million rooms occupied every day, and you do the math between the number of one-night check-ins, and then you compensate there's a little bit more two-night check-ins, that means that every single day, on average, there's 70,000 less check-ins a day than there was in 2019, okay? But they're staying a little bit longer, so that helps compensate for that. So the industry is kind of, from a demand standpoint, plateauing. If you now look at this from a demand standpoint, it's a totally different story, okay? The one-night stays only represent about a third of the demand. Now you start looking at the 7+ nights, the extended stay category, and in 2024, 21% of all check-ins were for 7 or more nights in the industry. That's a huge number, okay? Thinking 20 years ago, there wasn't any such thing as extended stay, okay? Really important point. And this is just the revenue number, which pretty much mirrors the demand number, okay? Now I'm going to talk a little bit about the federal funding cuts and how it might affect certain markets, okay? These are the markets that in 2024 had the most transient government business. Remembering that it's only people who booked a government rate category, but there's also lots of people who travel for government business that don't use the government rate category. An example is a lot of the funding cuts have really affected the consulting companies because they get these big consulting jobs for the government that are not going to go away. So those people, whether they booked a government rate, whether they booked a corporate rate, are not going to go if they don't have the funding, okay? So these are the markets that are most affected by in terms of room nights and in terms of revenue. And it's what you would expect, Washington, D.C. And from a room night perspective, each one of those 10 markets in 2024 had over 50 million room nights, okay, in those markets, okay? And D.C. had over 1.5 million room nights, government room nights. If that gets sluggish, which you think it will, then that's going to affect those markets. From a revenue standpoint, it's basically the same markets. If you talk about demand share and revenue share, then on the other hand, now here's the markets that really depend on that for a substantial part of their business, okay? Places like Fayetteville, North Carolina, Woodbridge, Virginia, Aberdeen, Maryland. If there is a substantial slowdown in government travel, these markets are going to be the most affected, okay? Because they're the ones that have relied on this over time. Now, this is the most complicated chart I created. I hate the chart, but I love the data on the chart, okay? We have 334 markets that we track, okay? And this slide shows the historical dependence on government, corporate, and the combination of the two. So the way to read the chart is 20% of all the markets, approximately 67 markets, get 10% of more of their demand from government business, okay? So concentrate on the red numbers on the chart. 30% of the markets rely 20% or more of their business is corporate, and almost 70% of those markets, 20% or more, rely 20% or more on government and corporate business. So if there is a slowdown in government business and a slowdown in corporate, which is a reaction to that, that's how many markets rely on that. Now, the bottom part of the chart is year-over-year bookings on the books beginning on March 10th for the next 30 days out, compared to the same period of time in 2024. Overall, on the books, government bookings are down 79% for the next 30 days compared to they were last year. That's a lot. That's a really lot. Down more than 20% is 43%, okay? And corporate, the same story. You know, corporate bookings in that 30-day window are down. Like Jan mentioned, but uncertainty equals reluctance. And there's going to be, you start hearing the R word all the time now, you know, and it's a bad word. It's worse than the F word. And so people start talking about that and they begin to slow down, okay? Now, everybody mentioned economic uncertainty, but there's some positive along with the negatives. And some of the positives are people have to be back in the office. You know, people back in the office could end up with more travel because you couldn't go to somebody's house to visit them for business. Now you can go back to the office. The other thing, which people don't talk about much, is one of the other things the administration is doing is kind of making it easier for corporations for compliance and those kinds of things, which means they're going to have more money, okay? And that more money might involve more travel. Like I said, the federal funding effect is not just government related because there's a cascading effect. Jan talked about Canadian inbound travel. I live in Philly, by the way, home of the Super Bowl champion Philadelphia Eagles. But if you live in Philly, there's the Jersey Shore and along there, Long Island. June, July, August, and September, the Jersey Shore market, historically, 25% of their guests are Canadians. If they don't come, it's a disaster for them, okay? It's a disaster for them. They may come, they may not, who knows? We talked about leisure travel stagnant. Jan talked about international travel, so I don't need to do that. So you can take a picture of that up there if you want a copy of the slides or anything like that, so please feel free to do that. Our forecast in terms of RevPAR change is almost identical to STRs at 1.9, but we're forecasting a decline in occupancy of 1%, saying that there's going to be enough of an effect on all those things that I talked about that'll be down 1%, and ADR will carry the day as it has. If I had to put my feet to the fire, I think that number's probably going to go lower instead of higher. And sometimes a lot of people ask me, what does 2025 look like to you? And now I have an easy two-word answer. Effing annoying. Jamie? Oh, Robert, sorry.
Thank you, Mark.
Mm-hmm.
Well, if you thought the demand and the ADR and the RevPAR forecasts were a bit depressing, we're going to talk about expenses and profits now. That'll get you excited. So, but before we do that, let's see, where's the... Oh, sorry. Before we do that, let me just share with you our current forecast. This was developed in early February, so it's before any adjustments made based on those economic assumptions as of early February. You can see our RevPAR forecast, 2.0 for this year, 2.6 for next year. Those are higher than the 1.8 and 1.9 that we just listened to. Remember those numbers because we're going to use those later in the presentation. So now let's talk about operating efficiency. We're just going to look a bit through the P&L statement. This chart here shows, got cut off. This is operating expenses on a per occupied room basis. Yes, I know not all expenses are variable, but I wanted to sit there and accommodate somehow or control for changes in business volume so we can make comparisons to inflation. Now, what we found over the past 50 or so years is that it's an expensive business to be in the hotel business. Typically, expenses rise greater than the pace of inflation. Let's focus on the last 2 years, 23 and 24. What we see in 2023, yes, once again, expenses rose greater than inflation. But in 2024, expenses on a per occupied room basis actually increased at a pace less than inflation. That's good news. But again, what you don't see here, this is total revenue per occupied room. And here's where the story is not as good. Long run, what's covering up our high expense growth is revenue growth, 4.5%, greater than the pace of inflation. More importantly, greater than the rise in expenses in a typical year. But what have we seen in the past 2 years, both years? Revenue growth less than inflation. More importantly, revenue growth less than the pace of expense growth. Looking at profit margins, again, both at the GOP and EBITDA line, the historical averages here, focusing on the last 2 years, well, good news is that we're actually above the long-run average in terms of profit margin in the past 2 years. Bad news, the trajectory downward. Why? Expenses growing greater than revenue. And in fact, if you look at this over the past 2 years, 18 of the past 25 months, if you look at the GOP margin of that month, it was less than the same month of the preceding year. And this trend has continued into January of this year. So not a good trend there. Focusing on the past couple of years, my colleague Bob Webster, yesterday used the term a sugar high. And to some degree, I think that happened in our industry as well. So coming out of COVID 2021, we saw revenues rise and we saw expenses decline. Think about cuts in services and amenities, less housekeeping, limited continental breakfast in the morning place. Well, that's a great recipe, raising revenues, declining expenses. 2022, things started to recover, we saw expenses rise, but we had great revenue growth to overcome it. So now all of a sudden we're achieving near record high profit margins. And I think people started to say, hey, wait a minute, maybe this is the new norm. We can operate hotels at 29% EBITDA margins, 35, 40% GOP margins. Well, that wasn't sustainable. And again, as we saw the past 2 years, due to that lack of revenue growth, we're now behind in terms of inflation, and we're behind in terms of covering expense growth. So declines in margins and such. So what does that mean in terms of the profit outlook? Remember our revenue forecast for next year and for this year and next, 2%, 2.6%, which is higher than what we heard previously. If you assume that total revenue will grow at those levels, if you assume different scenarios of expense growth, remember, expenses typically grow above inflation as well. These are the resulting margins, and under any scenario, the best case scenario, the worst case scenario, you can expect declining profit margins this year and most likely again next year. But that's the percentages. What's of really more importance, obviously, is the dollars. So we're looking at our sample of properties. They didn't fare very well in 2024. Slight declines both in terms of GOP dollars and EBITDA dollars. If you applied those same assumptions, let's say revenue grows 2% this year, 2.6% next year, maybe you're at inflation, a little below, a little above inflation. It's going to be a struggle to grow any profits this year, even in the best case scenario. Next year, revenue growth hopefully improves, some degree of expense control. You can still have declining margins, but you'll see the dollar profit levels increase next year. But look at those dollar growth levels, 2.2, 2.1%, below inflation, no real growth in profits is what that means. And just to verify that, again, if you look over the long term, in years when revenue growth has been less than 5%, profit growth has been limited to 2.5, 2.6%. So it's a struggle to make money or increase profits if you see low revenue growth. As Jan presented and Mark, the industry differs by chain scale. And again, this is sort of applying that same theory. What if things grow at our forecasts for the different sectors and different expense growth scenarios? The higher priced properties we're looking at here, luxury, upper upscale, they fared better in 2024. They actually earned profits, both at the EBITDA and the GOP level, or increased their profits. But looking towards this year, again, even with higher expectations of revenue growth, you're going to have a chance to achieve some profit growth this year, certainly at the EBITDA level, at the GOP level, but not the EBITDA level. And then come next year, again, our expectations for revenue growth in these two segments are north of 2.6. So the odds are pretty good. We'll see some revenue growth or profit growth next year at the upper price segments. But again, still below pace of inflation. As you move down the chain scales, again, they didn't fare as well in 2024, achieving losses in both the GOP and the EBITDA level. Again, not losses, but declines in profits at those levels. And our forecasts of revenue growth for these are less. I think 1% for upscale, and at that hard budget mid-scale economy, we're looking at like flat or 0.1% revenue growth for those years. So, the lower segments are just more vulnerable without the revenue growth. Inflation, expenses above inflation, it's going to be a struggle to certainly achieve any profit growth this year and certainly into 2026. So if revenue's not going anywhere, what are the expenses we should be looking at? This is what some of the things we saw in 2024, and you'll want to keep an eye on for 2025. Start with the labor, the biggest expense at any hotel. We all know the story, salaries, wages, benefits, up 33% since 2019. The good news, if you can say this, what's offset that, is that we're operating hotels with fewer people and fewer man hours. Difficult to find employees, cutbacks in services and amenities. So what that's helped to do is sort of offset the increase in compensation to the point where if you look at salaries and wages and benefits, total labor costs as a percentage of total revenue, we're still in that sort of range that we've been in over the long haul. But what's the direction of the arrow, the line? It's going up again, and if you listen to the truest economy, what's going up still? Compensation, salaries, and wages. So this is going to be one that's still obviously worthy of further monitoring. Going down the P&L statement, looking at the operated departments, for this sample, average daily rate increased 1% last year, yet my agency commissions are going up 6%. So obviously, if you're experiencing that, call Mark. He can talk about channel mix, how to control those. Complimentary F&B, for those of you that offer free breakfasts, you know about the increases in brand standards, the increases in food costs. Talking about increases in food costs, this was interesting. We looked within the food and beverage department. I would have expected, again, the grocery store, the egg story, all that food costs would have gone up. And we did a lot of looking into this to verify these numbers. We even consulted with STR and Hotstats. They're seeing the same trend. So what do we attribute it to, sort of the limited growth in cost of food? Well, first of all, higher contribution to banquet business as that group returns. So we're seeing sort of more profitable banquet revenue. Also just the change of how food is offered and the outlets at the restaurants, more buffets, et cetera. Cost and beverage declining. Well, you think that would be good. Why though? There was actually a decline in beverage revenue in 2024. Again, verified with other sources as well. People aren't drinking as much. Mocktail programs. So that's, good that the expense is declining, not so good that the revenue is declining. Into the undistributed, the overhead expenses. Again, this sample, 2.3% increase in total revenue. So if you look at things like credit card commissions and the franchise-related fees, which tend to be tied to revenue change, if my revenue is growing 2.3%, why are my credit card commissions and my franchise fees growing at a pace greater than that? Something to look at, something to talk to. IT expenditures proliferating throughout all the different departments and increasing. Maintenance, increased cost of supplies, equipment, some deferred maintenance, so there's more daily operational expense growth. Utilities is somewhat of a bright spot, only 2%. But if you read some industry experts in that field, commercial utility pricing may be going up, all competing for electricity with the increase in data centers. Down to the non-operating or more fixed expenses, well, if profits and revenues aren't growing, at least we don't have to pay the management company as much or big increases as we've seen. So, they're also feeling this as well. Property taxes, above inflation, above revenue growth. In our firm, we're seeing a lot of property tax appeal work. Certain markets, that's going to be more than others. And then insurance, 5th consecutive year of double-digit growth in insurance. And, with the fires and high replacement cost, the experts in that industry don't really see that price coming down either. So I'm going to leave you with a public service announcement. There's a new uniform system of accounts, the 12th edition, coming into effect in 2026. I bet you all have management contracts. In that management contract, your operator is supposed to report to you in conformity with the uniform system of accounts. So it's incumbent upon you, if you are an owner, to get a copy of the book at that address. During deliberations for this new 12th edition, the owners had a lot of influence. And there's a lot of new changes that are coming to provide greater transparency to those expenses that owners are most concerned about. Rising guest loyalty program costs, full-time equivalent employees, staffing levels, all the charges in one schedule that are charged to you by the management company and the brand. Those will all be required, mandated schedules in the new uniform system of accounts, and you should be seeing those in the P&L statements that you receive for your properties. So with that, I get to turn it over to Jamie. Thank you very much. Thank you, Lee, for the opportunity to speak.
Awesome. Great job, Robert. And I want to thank Lee and the Hunter team for having me again today. So my name's Jamie Lane. Prior to joining AirDNA, I spent 10 years in the hotel industry working for PKF CBRE with Robert, Mark Woodworth, and Mark, since you are in the crowd, I'll promise to keep things very simple and talk slowly. Yeah, okay. And then joined AirDNA 5 years ago. AirDNA, we track the short-term rental industry globally, every night booked, every listing around the world. And in this past year, I actually, for the first time, became a lodging operator. So you can see my short-term rental. It's up in North Georgia. You see my email address here. If you're interested in a 5-bedroom rental with a pickleball court, please book direct. All right, so a theme for today, because we are sort of pivoting away from hotels, talking about short-term rentals. My theme for today is if you can't beat them, join them. And if you can beat them, double down. Okay. And the them here is hotels. So if you can't beat them, join them. We saw Sonder this past year sort of join the Marriott family with their partnership. They're a large urban operator going after corporate extended stays. I think that was a great move for them. And the other is Vacasa. So Vacasa is the largest property management company in the, for short-term rentals in the country, 40,000 listings under management. And while they're not joining the hotel industry, they are taking a page out of the hotel industry. They are under contract to be acquired by Casago and moving to a franchise company. And we see a lot of franchise-type companies here, which I think is going to do a great job of moving the operations locally. Now, Jan talked a lot about recent demand trends, and my first 3 slides are all around what we're seeing in short-term rental demand and sort of near to midterm indicators on sort of booking activity and demand change. So in terms of stayed demand, so how many nights were stayed compared to the same month last year, so equivalent to how STR sort of tracks demand. In February, we saw demand up 5.2%, which was actually above the last few months of averaging about 4.7%. So you look at that, and you're like, things look pretty good. March, first 2 weeks, we're down 1%. So a little bit of hesitation coming into March. Now I'm gonna flip it a little bit, so now we're looking at monthly nights booked on a year-over-year change. So this is a little different than stayed demand. This is how many nights were booked during the month of February for future stays compared to February of last year. So this can have be stays that are happening in February, stays happening in March, April, May, June, out into the future. So this gives us a sense of real-time booking activity. And with length or lead times a little bit longer for short-term rentals, it can give you a good sense of how comfortable are people feeling about booking summer travel, spring break travel, because average lead time is about 60 days for short-term rentals. So here we see February was up 3.3%, which is actually significantly below last few month average of 6.7%. So again, a little bit of hesitation coming into February in terms of nights booked, and when we look at March, it's about flat. So again, a little bit of weakness. And I'm gonna take you through these weeks, because we actually saw bookings really deteriorate throughout February, and I bet if we put on this the stock market, you'd see it sort of deteriorate right along with it. So we started February pretty strong in terms of bookings. We deteriorated throughout the month, The first week of March, we were slightly up. And as of the time I had to submit this slide, I didn't have last week. Now I have last week, so there was a big question. Was it going to be negative? Is it going to be positive? What is happening? I haven't looked at weekly numbers in so long. But we're up 2.5%. So makes me feel okay. But when we think about, and maybe this is a caveat of looking at nights booked right now, we're looking at a time when we compare to last year, where we had Easter coming up, we had the eclipse. Anyone see that fun graph with short-term rental occupancy of the eclipse? It really spiked in the first week of April. That was the same week of Easter. So this time should be weak for bookings compared to last year because we had Easter and the eclipse. So this could just be a blip, and I'm talking about nothing, and you don't have nothing to worry about, and bookings are going to continue to accelerate as we get into April. And man, I hope that's true. Because right now we're talking about positive negatives. Short-term rentals is a growth industry. This is where all the demand's going. And over the past year, demand has been up. So trailing 12-month demand was up, what was that, 6.2% for the past 12 months. How much was demand up for hotels in the past year? Was what, flat?
Not that.
Not that. But what's really interesting, if I actually overlaid short-term or hotel demand in these same location types, it would be the exact opposite. So in urban areas, we saw short-term rental demand up 0.4%. Urban demand for hotels in those same locations was up 2.5%. If we look at demand for hotels in small and mid-sized cities where we see 10+% growth in short-term rentals, demand was actually negative for hotels. So as I see, if you can't beat them, join them. If you can beat them, double down. We are seeing short-term rental operators double down on where they can beat hotels and where they can differentiate. And we're going to talk a little bit about where we see that. So when we look at short-term rental demand and break it out by bedroom type, so remember about 6% growth over the past year, almost all that growth was for units 3, 4, and 5+ bedrooms. And when we look at the average room sold, or average number of bedrooms per room sold, back in 2016 it was 1.6 rooms. Today it's almost 2.6 rooms, 2.5 rooms sold per listing. So demand is pushing towards larger listings. And what's really interesting with short-term rentals is we essentially have the ability to reinvent ourselves every year based on demand patterns. So in any given year, and over the past year, there were almost 700,000 new listings added onto Airbnb and Vrbo. There's also about 640,000 listings that were removed. So only a net increase of 60,000 listings, but the shape of supply essentially changes by a third every year based on where we see demand going and the types of rooms that people are booking. And right now what we see is people are booking larger properties, they're booking nicer properties, they're booking properties with a hot tub, with a pickleball court, with a playground. Again, my email is jamie at airdna.co if you're looking for a great spot up near Lake Burton. That's the type of properties that people see that leisure travelers are booking, and that's what investors in short-term rentals are adding to the existing inventory. And then we also see demand for these higher-end properties. So this looks at the total nights sold for properties in purple over $1,500 a night, and in orange over $1,000 a night. And so the demand for properties over $1,000 a night has more than doubled over the past year. And so to give some context, short-term rental demand compared to 19 is up about 30%. And if you actually do it by room nights, so you count each listing by the number of bedrooms that the property has, it's up 37% versus 2019. So we're wondering where the demand's gone. There's a lot more demand in short-term rental today than it was pre-COVID. Now, some of the caveats on like what's going on in the industry. So what I've done here is plotted supply growth on a year-over-year basis at the time of the past 4 Hunter conferences. And now, when we think about, all right, everything's going great in short-term rentals, like, it's not really going that great in terms of, and only 4% supply growth. If things are going really well, you would think there'd be a whole lot more supply coming into the short-term rental industry. And what we see is, over this past year, there was only 3.8% more listings than over the same time. And looking at 2022, 20% growth, that essentially got us back to 2019 levels. 2023, we were going at 23%. 2024, we were going at 10%. And that sort of got us to today, where we're sitting at 33% more listings than 2019. And there's a lot of dynamics happening here. One is back in 2023, we saw a lot of markets with 10% growth. Now we're actually see, as we get into 2025, there are 60 markets that actually see declining supply. So with this sort of reinvent ourselves, with this churn that we actually see, if there's not new listings coming in, a market can turn negative like that. And that's what we're seeing for many markets throughout the country. And a big piece of that, and we hear it throughout the economy, it's high home values, it's high interest rates, and I'll show you in a second, deteriorating short-term rental performance. Occupancies have come down, RevPARs have come down. It is still a tough, actually, operating environment. And when you look at many of these really desirable places to add a short-term rental, home values are up over 50%. Home values are actually up over the past year too. So we hear about hotel values maybe coming down, the bid-ask spread narrowing. That's not happening for single-family homes in these areas where people want to add short-term rental inventory. Home prices continue to rise at a rate above that earnings are. So it's actually a really poor time to actually be investing in short-term rentals today. And that sort of shows up in the supply numbers. This is occupancy trailing 12 months over the past 6 years. Here you see that real peak that we saw in 2022, a combination of declining supply, demand came back strong, supply growth 10% in 2022, 2023, 2024, pulling occupancy down. Finally, we've plateaued though, and are seeing slight increases. So this is where occupancy we always forecast, it sort of hovers around the mean. We've finally seen it stabilize, and our expectation is a slight up over the past few years, and we see we're still significantly below 2019 pre-COVID levels. And then this is our outlook, my final slide on what we expect for short-term rental performance going forward. You see on supply growth, our expectations is maybe 4.5% over the next couple of years. That is above that of, I think, all the expectations around hotel supply growth of about, 0.5%. So we do expect, both on the supply and demand side, short-term rentals to continue to take share away from hotels. But where that's happening is not in urban, it's not even in suburban areas. It is all those areas outside of those top 50 MSAs. It's where the pipeline probably for hotels shows that new hotels aren't coming in either. So you guys are just seeding this area of like, all right, you guys grow here, we'll grow here, and maybe we don't have to actually compete that much. ADR growth, we're expecting 2.7%. A piece of that is that more demand is going into these higher rated properties, larger properties. And then RevPAR change, we were slightly or decently positive in 2024, up 3.7%. Big increase from the decline of 8.5% in 2023. And then maybe some moderation in 2026, down to 2.4. A big piece of that is ADRs getting more back to long-run average and slight gains in occupancy. So with that, I want to thank you all for your time, and I think Lee's going to come out and ask us all some questions.
All right.
Thank you, gentlemen. As Jamie said, I'm now here to ask a bunch of questions on the iPad. There's the QR code if you didn't have it and weren't able to download the app earlier. Again, go to this session, click follow, and then you can log in and ask questions that hopefully we'll be able to get answered. Let's see here. All right. Mark, this one's for you. Whether it's positive or negative, what demand segment will be hardest hit by a recession?
Probably, if there is a recession, it would almost certainly be the upscale ones that got hit the most. Because that appeals to the group, that appeals to corporate travelers. You know, if you think about if there's a recession, the segment that'll stop traveling is probably most likely the corporate and leisure. And one of the things that I didn't talk about on my slide, so now you give me an opportunity to veer off your question and get into something else, is when I talked about the one-night stays, that was especially prolific in the economy and mid-scale segments, okay? And the common rhetoric around that is that, you know, people can't afford to travel, and the ones that are most cost-conscious, traveling consumer, aren't going to economy hotels. And yes, that's partially true, but the real culprit there is the one-night stays. It dropped by it dropped almost 20% from 2019 to 2025, which means that, and it was Monday through Wednesday, which means it wasn't necessarily leisure travelers. So I think that segment's, I don't want to say it's the safest, but it probably doesn't have much farther down to go. So I'd say, you know, the higher end of the marketplace is probably going to be the one that's most affected from a demand standpoint.
Okay. Robert, for you, what's driving inflation projection to be higher in 26 than 25?
Inflation.
Inflation?
Yeah.
Well, can I caveat and say I'm not an economist? So I may yield to any other of my panelists who think why the national forecast of inflation. Expense growth, maybe I'll tackle that, expense inflation. Again, if you look at the long run history, expenses have grown over the pace of inflation, but it was controlled last year. So I'm optimistic that hoteliers in general will control expenses to the best of their ability. If you remember in that slide, while margins have been down the past 2 years, they are above the long run average. I'll quote, again, my former boss as well, Mark Woodworth, who used to say, hoteliers manage to the margin. So if you don't have dollars, you don't spend dollars. So in terms of cost inflation, I think hoteliers will just continue to work hard. It's really a revenue story. As far as the national economy inflation, I may take a pass on that one.
Probably has something to do with tariffs.
But I mean, you talk about tariffs, you talk about lack of access to labor because of clampdown on immigration, which drives up wages. And then if wage growth, I think the economist just made this interesting chart, right? Wages are going to continue to go up, which means prices are going to continue to rise as people spend more. The people in the economy feel more positive raising their rates. So I think that's just sort of the natural cycle. So yes, you feel that you're getting a good bump up in your wages, or that we have to pay higher wages, but everything else is getting more expensive because of that.
Okay. Jan, let's stay with you for a minute. Net purchase intent, which looks over 3 months, still looks strong. How does that make you feel about leisure travel for the start of Q2?
I think there's a difference between intent and action. So if you probably asked this question, how do you feel about Q2 at the beginning of Q1? And I think all systems will go between November 5th and January 20th, 12:02 p.m., and then things deteriorated rapidly, I think, in consumer sentiment and in outlook and in being able to plan, right? I think after the inauguration, we have just had this whiplash of a lot of different topics being thrown at the consumer. And to quote Mark Lomano, if you're just not sure about the future, you're just going to sit. Inability to plan makes you take a pause. And I think that's what consumers are doing. I still think that the next 90, 180 days are going to just be bumpy because the American consumer is saying, oh, there are some layoffs. You know, not me, but my next door neighbor, maybe. And oh, the stock market, my 401k is not quite as robust as it used to be. So yeah, I'm still going to go, but maybe I'm just going to go 7 days. I'm going to go 5. I'm not going to go upper upscale. I'm going to go upper mid-scale. You know, like that's going to continue to be the story, I think. I'm not doom and gloom, but I think we have to be cautionary on the top line. And every single point Robert made is not going to go away. The expense growth story is the story of 2025.
We're hearing a lot of that from you guys. I'm going to just put this out there to whoever would like to field it. What percentage of U.S. room night demand and short-term rental demand come from international inbound? And how much of each is forecasted to grow or contract in 2025?
Not enough.
Yeah, and I can say for short-term rentals, because I think it is higher than hotels, about 13% of demand comes from international travelers for U.S. domestic or listings, and about 3% of that comes from Canada. So Canada is 3% of total short-term rental demand, U.S. short-term rental demand, international. So, and in that Oxford presentation, we saw their forecast at the beginning of the year was for like 10% increase of inbound demand, or inbound travel. Now they've revised that to like -5%. So I think, and when we look at like what Jan showed, the I-94 data, like it's 10% below 2019 levels, and now we expect it to get probably worse.
Yep.
And that could, and at the same time, outbound demand is at 20% above 2019 levels, and it could significantly get stronger, which is like a great story for European hotels, European short-term rental operators, not a great story for US operators.
Let me take the counter up, just to confuse you more, let me take the other side of that conversation. So the point of the strong dollar that drives everybody abroad, if you feel less certain, you may take that dollar and stay here and say, well, I don't have to go to Venice again. I was there 2 years ago and 3 years ago. Let me just go back to the Keys. Let me just go back to Colorado. So I wonder if this global uncertainty and the uncertainty within the United States will make some people stay closer to home. So I wonder if that 20% number doesn't re-accelerate but come down. That is a very positive read of the data. I'm making that up as I sit here. You know, that is one way that you could interpret it to say, oh, maybe it's not all as bad. Coming back to your original question, I'm quoting now Marriott International as saying that this is in the US, 96% of their demand is domestic. So it's only 4% that is non-domestic, and within that, I think like Mexico and Canada make up 2 points of that, so roughly half. So it's not a super huge big deal. I think the I-92 APIS data said how many people are flying into the US, it's 70 million. You know, so whatever, you can do the math yourself. So I think it matters more on the higher end, you know, and clearly you're getting a lot more on short-term rentals.
Yeah, and to Jan's point, the dollar has weakened, like with all this volatility we've seen. And
Ish, yeah.
Ish, yeah.
Some other points on that too is like, Jan's right, the international travelers coming to the US is kind of icing on the cake for kind of how the industry performs. It's kind of a little bit more to that. But also, I think Jan's hit on something with potentially Americans staying here. I think depending on what country you want to travel to, we don't exactly have the best reputation worldwide. Not so much as travelers, just as, you know, regardless of your political beliefs, I think people in the rest of the world are a little unsure about who Americans are these days. And they have every reason to think that. So I wonder if some people are like, you know what, I don't want to answer questions about the election. I don't feel like talking about any of that. If I stay here, I don't have to deal with it. You know, so Jan, it might actually, but it's impossible to tell. Some people are like, I don't care, I've been planning to go into Spain and Italy for the last 10 years, I'm going.
Right? Yeah. Ask me in August, I guess.
More uncertainty.
Okay, speaking of asking you in August, how has what, for all of you, presented today, how does it compare with what you presented last year in 2024?
Are there any other questions?
That's
That's a legit question, by the way.
That's almost like a question that starts, isn't it true? Is that late? Well, it's definitely a lot different. The whole economic climate has changed around how you think about. In 2024, there was no, when you make a presentation at a conference like this, it was like, okay, this is going to be an okay year. It's not going to be a great year, but there wasn't this, well, we're not going to be sure what's happened this, we're not going to be sure what's happened there. Anything that was going to disrupt your forecast was probably an external event, like something that was unplanned, whatever, those kind of like economic disaster or those kinds of things, terrorism. But now it's like, what we presented today, we could be done this presentation, look at the news and go, oh, it's all different now. and change the forecast. So it's like nobody really knows what's going to happen. And forecasting is difficult in the most calm times. These are not calm times. So it's like, how is it different? It's like, you could almost like flip a coin and say, this could happen, that could happen, this could happen. I don't know. Makes it different, makes it hard. It also makes it so you can say anything you want.
I don't know that our data changed a whole lot from a year ago. I think our sentiment changed. I think we're still saying, look, we look at the data, we use the macroeconomic forecasting engine, we put it on the grinder, and out comes a RevPAR forecast, with a little bit art and some science, out comes a RevPAR forecast. But I think where we sit here today, I think we feel a lot less convicted about the numbers that we put out. I think a year ago, I think we were with Mark, it's like, yeah, this, there's an election coming up, and then, a party is going to win, and then that's going to give us clarity, and then that's going to make it easier to plan. I don't think we feel like that today.
Yeah, and the biggest thing for me is an interest rate outlook. Like from when we were here last year through to September, we saw 10-year declining, we saw 30-year fixed rate mortgages declining, we saw the cost of debt. Like we're all excited of what the outlook for 2025 was going to be. And then November, like it just entirely changed. Like you throw our outlook for transactions out the door, we saw the certainty that those costs were going to continue to decline out the door. And that has changed our outlook for supply growth for short-term rentals. Sure, it's changed a lot of our outlook for just overall hotel investment activity. Like that sort of shift that we went through, I think caught a lot of us off guard. And I'm glad my job isn't forecasting interest rates, because that's a tough one to do and throughout any cycle.
All right, we got time for one more question, and it's similar to the topic, Jamie, you just mentioned, the transaction market. What's your advice for hotel owners who are currently or may begin to struggle economically? Sell or hold?
Call your favorite broker.
Hi.
Listening to my colleagues, I think that counseling is one of, or it's definitely shifting more towards be realistic as your owner. If you're an owner, about your expectations for return or price you can get, and probably more pushing towards, and I'm not a broker, advising clients to sell.
Don't disagree with that. I think if there is, using the R word again, then it's probably a decent time to try and buy. If you can financially do that. My advice would be something a little different, is don't lower your rates.
We talk about that?
Huh?
Did we talk about that?
No, we didn't
Can't talk about that.
But the thing of it is like, I think the industry, from a pricing standpoint, now recognizes that they're catering to basically, and I'm going to steal something Mark Woodworth mentioned to me. But I never worked for him. That the lodging industry increasingly caters to people who, A, have the time to travel and the money to travel. That population in the U.S. is not shrinking. So if indeed you're catering to that group, I don't think they're as price resistant as people thought they were 15, 20 years ago. The elasticity of demand as it relates to pricing isn't there at the high end. It really isn't. You know, people are willing to pay. So if you don't fall into that trap of like, okay, you know, demand's a little soft, we better lower our rates, that's probably a flawed strategy, in my opinion. Of course, I don't own any hotels, so it's easy for me to say stuff like that.
I'll give a note of optimism. Going to a lot of short-term rental conferences over the past few years, I'd say if you are looking to sell, there's a lot of guys that have built their portfolios of short-term rentals that now wish they were all under one roof and want to graduate to hotels. And if you're looking for a new buyer out there that maybe doesn't know all the trials and tribulations of having all those rooms under one box, like you might find
Ignore the pro forma, just go ahead and buy it.
a new buyer. Yeah.
Don't do the math, right? Is that what we learned yesterday? Well, thank you. Appreciate your time this morning. Everyone, please join me in thanking the guys.
Thank you very much.